In my experience, we need a real precious metals bull market in order for silver to break out. And in the gold trade, I don't think, well, we probably are in the early stages of a bull market. But I would point out to you that an awful lot of the gold buying has been central bank buying. What we have seen is dramatic moves in some silver equities that have performed as companies. But it's a really interesting print.
Spot silver prices have surged by 35% this year, reaching 12-year highs and trading around $32 per ounce, while spot gold prices, now approximately $2,350 per ounce, have seen a more modest gain of 14% year-to-date. Gold's rise has largely been driven by central banks seeking to diversify their reserves and a consumer flight to safety amid global economic uncertainties, particularly in China. In contrast, silver's impressive performance is primarily fueled by industrial demand. This divergence highlights silver's unique dual role as a precious and industrial metal. According to legendary investor Rick Rule, gold often takes the lead in historical bull markets, with silver following closely but typically accelerating at a much faster pace. This pattern has been observed repeatedly, but skepticism lingers this time. Some market participants believe that non-market forces, such as manipulation, might be holding back silver's true potential despite clear demand pressures. Notably, China's appetite for silver has intensified significantly, with imports hitting a 3-year high of 390 tons in December and 340 tons in April, well above the 5-year monthly average of 310 tons as reported by Bloomberg. This strong demand has driven domestic silver prices in China above international levels, suggesting that the region's imports could continue to rise in the coming weeks. The Silver Institute has forecasted global silver demand to outpace supply for the 4th consecutive year in 2024. This tight supply-demand dynamic is already reflected in the substantial gains of certain silver equities. With high-quality silver companies having relatively small market capitalizations, any significant influx of investment from general investors could lead to sharp upward price movements. Rick emphasizes that savvy investors are positioning themselves early, recognizing silver as a high-reward opportunity that outweighs the inherent risks, particularly if broader market sentiment shifts positively toward precious metals. Please tune in for our exploration of Rick Rule's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
In my experience, we need a real precious metals bull market in order for silver to break out. And in the gold trade, I don't think, well, we probably are in the early stages of a bull market. But I would point out to you that an awful lot of the gold buying has been central bank buying. I would ask you to look at your own gold brokerage business in terms of retail participation. While it is true that for the last 20 weeks, there has been net retail buying, at least as evidenced through the ETFs, that retail buying is tepid. The move that we've seen in the gold price, while welcome to the gold adherents, is not anything like the move that we saw in the gold price in 1971 or 1976, or in 2002, 2003, or in 2009. And it takes that type of buying. It takes a dramatic move in the gold price, and it takes a growing recognition of the precious metals narrative among generalist investors, not you and I, to move the silver price. And we haven't seen that yet. What we have seen is dramatic moves in some silver equities that have performed as companies. Look at Silver Crest after the disappointment around the reserves valuation when they reached nameplate capacity and started generating cash. Stock's been on a tear. Mag Silver, stock's been on a tear. The thing that I want to point out to your listeners is that the market cap of reasonable quality silver companies is so small that, first of all, when the generalist investor decides to crowd into them, there isn't enough room in the market caps to contain it. And secondly, there's a coterie of professional investors, myself included, who is willing to buy the high quality silver stocks in anticipation of the money coming into it, in the same fashion that there was a group of us willing to buy uranium stocks in 2021, understanding what would happen in the face of the uranium price increase. There's a group of us that are, I wouldn't say we're happy, but we're conditioned to being a year and a half or 2 years early. And what you're seeing in those high quality silver stocks is absolutely pro-positioning. Are we going to be early? Probably. Are we going to be wrong? Maybe. But it's a really interesting print if you think about putting together a portfolio of those companies where if you're wrong, you lose 30, 35, maybe 40%. And if you're right, you make 500% or 600% or 1,000%. It's precisely that juxtaposition of risk to reward that your listeners need to familiarize themselves with. And while they all want the upside, they need to ask themselves if they can stand the volatility, if they can stand the time it takes to be involved in the trade. And most importantly, if they're willing to do the work to segregate in movie terms the good from the bad, from the truly ugly, because there's lots in that latter category.
According to Rick Rule's analysis, balancing liquidity with market participation is a complex challenge that requires careful consideration of various factors. On one side, holding cash provides a safety net, enabling investors to swiftly respond to market fluctuations or take advantage of sudden opportunities. This liquidity is crucial during periods of economic uncertainty or market instability, as it allows individuals to avoid potential losses and make strategic decisions without being forced to sell assets at inopportune times. However, the downside to holding large amounts of cash is the erosion of its purchasing power due to inflation. As inflation increases, the real value of cash diminishes, meaning that over time, the same amount of money buys fewer goods and services. This reduction in purchasing power can lead to missed opportunities for investment growth, as cash that could have been invested in appreciating assets or assets yielding returns instead loses value. The challenge, therefore, is to strike a balance between maintaining enough liquidity to manage potential market downturns or liquidity events, like those experienced during the 2008 financial crisis, and investing in assets that can outpace inflation and generate returns. During the 2008 crisis, liquidity was essential for navigating the tumultuous market conditions, demonstrating the importance of having cash reserves to manage sudden drops in asset values or other financial disruptions.
Can see the future. Only hindsight's 2020. I joked with you before, Dunnigan, that bearishness hasn't paid for me. Doug Casey and I joke that we've accurately foreseen 17 of the last 3 recessions. And so I try to stay partly in the market, but I also maintain a fair bit of liquidity, in effect attempting to have my cake and eat it too. We've talked before too, Dunnigan, about the fact that having cash necessarily means negating purchasing power. If you're receiving 4.5 or 5% on your savings, and the purchasing power of your savings is declining at 7.5% compounded, it means that your purchasing power is declining by 2.5% a year, which is unpleasant. But if you believe that there is a reasonable chance of a decent decline and an outside chance of a liquidity event like 2008, then I think that you have to be reasonably liquid, which I am. Now, I need to say that in my life, I've made money on the micro, not on the macro. I've made money by studying individual companies in greater depth than other people have, and deciding sometimes that almost irrespective of the big picture outcome, that something is cheap enough, or at least that the juxtaposition of risk to reward is attractive. So while I believe that Biden is a risk, Biden's not a risk anymore. He's on the beach where he can do no harm, which is great. If you believe that Ms. Harris is a risk, and if you believe that Trump is a risk, I would point out to you that both are true, but your greatest risk is you. Your greatest risk is not controlling your emotions, not doing enough work. Don't let Trump or Harris be an excuse to fail. Remember that it's your money and the buck stops with you. I need to say that I am concerned in the intermediate term that so many of the idiotic policies of both candidates attract anything but widespread skepticism and scorn among the electorate. But I'm not going to let that intermediate term concern keep me from making money. I was going to say that I would try to make money despite them. That's wrong. I'm going to try to make money to spite them. Among other reasons. I suspect that should Ms. Harris be elected, that the market will perform less well in the near term than should Mr. Trump be elected. The reason for that is that most investors are or seek to become rich people. And Ms. Harris is running on a determinedly populist theft agenda. The idea of taxing unrealized capital gains is a completely preposterous idea, but the fact that it's attracted so much positive attention is a little scary in the long term. It makes a professional investor like myself feel sort of like I'm walking down the street with a bullseye painted on my back. I don't expect her to get away with it. You know, those Wall Street backers of hers who have always prevented, as an example, the carried interest exemption from getting taken away, probably have a little visit with her, you know, slap her around a bit after the election. What bothers me isn't so much the proposition as its popularity outside the Beltway, and that is scary.
The balancing act between liquidity and market participation will likely become even more critical as economic conditions evolve. As market liquidity becomes increasingly strained and inflation diminishes the value of cash holdings, silver is poised to become a pivotal asset. Given the ongoing depletion of silver reserves and the escalating demand, we can anticipate a substantial increase in silver prices. This scenario underscores the importance of strategic investment in silver as a hedge against market volatility and inflationary risks. Do you agree with Rick's predictions and analysis? Please share your thoughts on the video. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for watching, and we hope to see you in the next one.